In April 2024, China liquidated $53 billion in U.S. Treasury bonds in a single month. It wasn't market conditions that triggered this. It was something far more calculated. Over the past decade, China has systematically reduced its U.S. debt holdings from $1.3 trillion to just over $600 billion, taking losses in the hundreds of billions. Nations don't voluntarily lose that kind of money unless they're preparing for something worse. This wasn't a sale, it was an exit. When sovereign nations liquidate assets at catastrophic losses, they're not reacting to economics. They're preparing for war, sanctions, or the collapse of the asset itself. And right now, the exact same pattern is unfolding. This wasn't luck. This wasn't coincidence. Economic historian Charles Kindleberger identified a 5-stage pattern that appears before every shift in global reserve currency dominance. The pattern doesn't predict crashes. It predicts transitions of power. And transitions of power destroy wealth on a scale most people can't comprehend. Let me show you how it works. Stage 1 is accumulation. The rising power buys the dominant power's debt in massive quantities. They do this to stabilize trade, build reserves, and integrate into the existing financial system. China did this from 2000 to 2013, becoming America's largest foreign creditor. Stage 2 is peak holdings. The rising power reaches maximum exposure. In 2013, China held $1.3 trillion in U.S. Treasuries, more than any nation in history. At this stage, the relationship appears stable. Economists call it mutually assured economic destruction. Both sides benefit, and both sides are locked in. Stage 3 is strategic reduction. The rising power begins selling, slowly at first, quietly. They cite technical reasons, portfolio rebalancing, currency management, domestic needs, but the reduction is systematic and intentional. Between 2013 and 2020, China reduced holdings by $300 billion. Wall Street called it rotation, but it was preparation. Stage 4 is accelerated exit. An external shock triggers acceleration. For China, that shock was February 2022, Russia's invasion of Ukraine and the subsequent Western sanctions that froze $300 billion of Russian foreign reserves. Overnight, China learned that holding U.S. assets wasn't just an investment decision, it was a geopolitical vulnerability. Stage 5 is asset conversion. The rising power doesn't just sell paper assets, they convert them into physical resources that cannot be frozen, seized, or sanctioned. Gold, oil, copper, agricultural commodities, infrastructure, things that exist in physical space, beyond the reach of financial warfare. The pattern is mathematical. It appeared before Britain lost reserve currency status to America. It appeared before the collapse of the Bretton Woods system. And it's appearing again right now, but there's one element that makes this different and far more dangerous. We'll get to that. Let's examine the historical precedents, because this pattern doesn't just predict transitions, it predicts the destruction of wealth for those who don't recognize it. Before World War I, Britain was the undisputed financial center of the world. The pound sterling was the global reserve currency, and British government bonds were considered the safest asset on earth. Between 1870 and 1914, the United States accumulated massive sterling reserves integrating into the British-dominated financial system. By 1914, U.S. institutions held peak exposure to British debt and sterling-denominated assets. Between 1914 and 1917, American banks began strategic reduction, citing concerns about war financing. In 1917, the U.S. entered World War I, but not as a debtor, as a creditor. American institutions accelerated their exit from sterling assets, converting holdings into gold and domestic bonds. By 1919, the U.S. had become the world's largest creditor nation. Britain, drowning in war debt, was forced to maintain artificially high interest rates to attract capital. The economic strain contributed to the 1920s depression in Britain, while America experienced the Roaring Twenties. British bondholders who stayed in sterling assets lost 40 to 60% of their purchasing power over the next decade. The transition wasn't just financial, it was the end of an empire. But it didn't stop there. After World War II, the dollar became the global reserve currency, backed by gold at $35 per ounce. Foreign nations, particularly France, accumulated dollars with the promise they could convert them to gold at any time. France, under Charles de Gaulle, accumulated massive dollar reserves through trade surpluses in the 1950s and 1960s. By 1965, France held peak dollar exposure, billions in U.S. Treasury securities and dollar deposits. De Gaulle publicly questioned the fairness of the Bretton Woods system. Starting in 1965, France began converting dollars to gold, citing structural concerns about U.S. fiscal policy. The acceleration came between 1969 and 1971. As U.S. inflation rose due to Vietnam War spending, multiple nations, France, Germany, Switzerland, rushed to convert dollars to gold. The U.S. gold stock at Fort Knox dropped from 20,000 tons to under 8,000 tons. August 15, 1971. President Nixon closed the gold window, ending dollar convertibility to gold. Nations holding dollars couldn't convert them. They were holding paper backed by nothing but trust. The dollar lost 30% of its value against major currencies within 2 years. Nations that held dollar reserves suffered massive losses. Those who had converted to gold early, particularly France, preserved their wealth. The pattern appeared again in the 1990s. Before the 1997 Asian financial crisis, many Asian nations held their reserves in dollar-denominated assets, particularly U.S. Treasuries. Thailand, Indonesia, South Korea, and Malaysia accumulated dollar reserves through export-driven growth. The crisis hit in July 1997. Currencies collapsed and the IMF imposed harsh conditions. But one nation was watching and learning: China. After witnessing how dollar-based reserves could evaporate during a crisis, China began a systematic program of reserve diversification. They didn't just accumulate dollars, they accumulated gold, strategic petroleum reserves, and control over supply chains for rare earth minerals. This is where China learned the lesson that would define their strategy for the next 25 years. Financial assets can be frozen or devalued. Physical assets cannot. Now let's fast forward to today. According to U.S. Treasury data, China's holdings of U.S. government debt have fallen from $1.3 trillion in 2013 to approximately $650 billion in 2024. That's a reduction of nearly $688 billion. It's the largest sustained reduction by any foreign creditor in history. But here's what makes this unprecedented. China is selling at a loss. Between 2010 and 2013, China was buying U.S. Treasuries when yields were at historic lows, many bonds yielding under 2%. Today, with rates above 4%, those bonds are worth significantly less on the open market. Selling them means taking a haircut of 20-40% depending on maturity. Why would China accept these losses? February 24th, 2022, Russia invades Ukraine. Within weeks, the United States and European Union freeze over $300 billion in Russian foreign reserves. Russia, which had accumulated these reserves as insurance against sanctions, found them weaponized against them. According to geopolitical analyst Michael Pettis, the freezing of Russian reserves was the most significant financial event of the decade, not because of the amount, but because it revealed that reserve assets aren't neutral stores of value. They're geopolitical liabilities. China was paying attention. Within 3 months of the Russian sanctions, China's treasury selling accelerated. Between March 2022 and December 2023, China liquidated over $200 billion in holdings. They weren't rotating into other Western assets. They were exiting the system entirely. Here's what nobody is telling you. When China sells U.S. treasuries, someone has to buy them. And increasingly, that someone is revealing a dangerous pattern. Now here's where it gets disturbing. Every single stage of this historical pattern is present today. But there's an additional element that didn't exist in previous transitions: forced absorption by U.S. allies. Let me show you the data. According to Treasury International Capital Reports, as China has reduced its holdings by nearly $700 billion since 2013, 3 entities have dramatically increased their treasury purchases. This is the Bagholder Alliance. The United Kingdom's holdings increased from $150 billion in 2013 to over $600 billion in 2024. But here's the problem. Britain's economy is smaller than China's. This isn't organic demand. Much of this represents Caribbean hedge funds and financial centers, and British territories being used to absorb Chinese sales. Belgium, a nation with a GDP of $600 billion, somehow holds over $330 billion in U.S. treasuries. Belgium's holdings have tripled since 2013. Belgium isn't buying these bonds. Its role as a European financial clearing center means it's being used as a pass-through to mask who's actually absorbing the supply. Japan has always been a large holder, but Japan's holdings have remained artificially elevated at around $1.1 trillion despite its own mounting debt crisis. Japan is paying over $600 billion annually just to service its own debt, roughly 20% of tax revenue. Yet they continue buying U.S. treasuries at Washington's implicit request. This is the Bagholder Alliance, allies forced to absorb assets that China is systematically exiting. While reducing treasury holdings, China has been on a historic accumulation spree of physical assets. According to the World Gold Council, China's official gold reserves have increased by over 300 tons since 2022. But that's just official reserves. Unofficial accumulation through state-owned enterprises and private sector buying, encouraged by Beijing, suggests total accumulation could be 1,000 plus tons annually. China's strategic petroleum reserve now holds an estimated 1 billion barrels, second only to the United States. They've been filling this during every oil price dip since 2020. China controls or has secured supply agreements for 60 to 80% of global lithium, cobalt, and rare earth production. not through market purchases, but through direct ownership of mines in Africa, South America, and Australia. Since 2019, China has accumulated record stockpiles of corn, wheat, and soybeans, more than 50% of global reserves for some commodities. The parallels are mathematical. France converted dollars to gold before Nixon closed the window, and now China converts treasuries to gold before potential sanctions. Britain struggled to finance war with declining credibility, and now the US runs trillion-dollar deficits with declining foreign demand. Rising powers prepared for a new system then, and now China builds institutions outside the dollar system. The CIPS payment system, digital yuan, bilateral currency swaps with over 40 nations. Right now, the Congressional Budget Office projects the U.S. debt will reach $54 trillion by 2034. Annual interest payments already exceed $1 trillion, more than defense spending. The Treasury market, once the deepest and most liquid in the world, is becoming increasingly political. Bond auctions that once attracted global demand now require increased indirect bidding. This is a technical term that often means the Federal Reserve or domestic banks are buying what foreigners reject. And here's the most dangerous parallel of all. In every previous reserve currency transition, the majority of bondholders in the old system didn't realize the transition was happening until it was complete. They weren't stupid, they were unprepared. So what happens next? If history is our guide, we're in the final stages of this pattern. Stage 5 is well underway. China is converting paper claims into physical assets at an accelerating pace. The Bagholder alliance is absorbing what they exit, and the Treasury market is being quietly restructured from a globally diversified asset into a geopolitically concentrated one. The trigger event, the moment this becomes obvious to everyone, could come from multiple directions. A Taiwan escalation that triggers U.S. sanctions on China, immediately revealing that America's largest foreign creditors have already positioned for this. A debt ceiling crisis that exposes the fragility of forced absorption by allies, or simply a continued systematic reduction until China's holdings drop below $400 billion, the point at which they're no longer economically interdependent, just strategically opposed. The people who got destroyed in 1971 weren't stupid. They believed Treasury securities were backed by gold until they suddenly weren't. The people who held sterling bonds in 1919 weren't stupid. They believed in the stability of the British Empire until it was gone. Nobody warned them, and nobody will warn you either. This isn't about predicting a crash. It's about recognizing a transition. And transitions don't announce themselves with headlines. They happen in Treasury International Capital reports that nobody reads, in gold purchases that get mentioned on page 17 of financial newspapers, in strategic petroleum reserve data that seems too boring to matter until it does. By 2026 or 2027, we will look back at this period and recognize what was obvious. China wasn't selling treasuries to manage reserves. They were preparing their balance sheet for a world where U.S. assets are no longer safe stores of value. They're geopolitical liabilities. The question isn't whether this transition will happen. The question is whether you'll recognize it before it's complete. History never asks permission, it just repeats.